Thank you for attending our webinar today, New Year Personal Finance Strategy for Business Owners. I am your moderator, Jenny Alton from the New York Small Business Development Center Central Office. We are delighted to have Delano Saporu, who is the CEO and founder of New Street Advisors Group and a CNBC contributor, as your presenter today. This webinar is brought to you by the New York Small Business Development Center network of 20 campus-based centers and outreach offices, which are located across New York State, along with a central office based in Albany. The NYSBDC is a U.S. Small Business Administration resource partner. Our free advising, education, research, and advocacy services are made possible by funding from the SBA, New York State, and our host campuses. So you know, we are recording today, and we will share the recording with attendees in the next few days, along with a PDF copy of Delano's slides, and that will come to you in a follow-up email. Attendees are muted and will not be on camera today. Your chats will only be visible to me and to our presenter, and I will open the chat shortly here. If you have any questions during the presentation, please don't hesitate to type them in the Q&A box as they come up. You can open Zoom's Q&A box from the Q&A button at the bottom of your Zoom window. Delano will take some pauses during his presentation for questions, and he has provided a form link through which you can contact him for further information. I will drop that into the chat in a few minutes. For specific questions that may take more time and detail to answer, or if we run out of time to answer all questions today, please get in touch with Delano through his form link. And you can also reply to the follow-up email you will receive to get further assistance. So all of our housekeeping is out of the way, and Delano, I will turn the time over to you.
Thank you very much, Jenny, and thank you all for attending and being here today. Want to really say thank you to Jenny, the New York SBDC, for putting on these webinars and these workshops, because I think, one, it gives me the opportunity to, hopefully teach a little bit that could be helpful for you in your journey, as well as us to gather and kind of learn from each other in this time as small business owners, sole proprietors, people that are thinking about being a small business owner, a sole proprietor. This is a great way for us to continue that fellowship. So thank you all. Chat is open. So as Jenny mentioned, please drop stuff in the Q&A. Any questions, we're going to take pauses through each section. Also, the forum link for those that want to learn a little bit more and have more in-depth specific questions, or just want to connect in general, please make sure you utilize that. Jenny did a great job of introducing who I am, so I'll do not much on that, but we'll get into a little bit of our presentation here today. So more about me and more about what we're really here to talk about, which is your finance strategy for the new year and how we're going to attack the new year. So a little bit more about me. I live in New York. I work as a financial planner, advisor, and business coach advisor for a lot of different families. Different people across the country. I do CNBC contributor. I do investing, and actually started a new project, if you can't believe it, as a sports agent. But we'll talk about that another time. But that's a little bit more about me. So my experience and background starts from doing my MBA and then going into finance before starting a registered investment advisory firm. So that's a little bit more about my background. And let's go into a little bit of our agenda today, which is going to be setting the 2024 goals and objectives and looking at the past too, because I think it's important to look at the past to get a little bit of gauge of how you did, what we could do better. We'll talk about budgeting, saving for retirement in all the different ways, as a sole proprietor, as a small business owner. All those different ways are super, super crucial. So we'll talk about that as well in a second. And then we'll talk about tax strategies and transition tips. So for those that are looking to sell their business, do any of those things alike, we'll talk about how that could certainly look for you in the future. So those are kind of our agenda topics. The first one being setting goals for 2024. I really like this topic in the sense of the way you set it up for the year is I'm getting better and better at doing it. I think the first few years I just kind of wrote down goals on a Word document and I'm like, all right, that's it. But now I'm getting a little bit more specific. And my fiance actually helped me get a little bit more in-depth specific on how to do this. And maybe this will be helpful for you. So how will you grow your business and your personal finances? So I do think it makes sense to have it quantifiable. Like, can you grow 30% from last year? So this year, can you grow by 30%, right? Right. So plain English, $100 goes to $130 of revenue versus $100 in 2023. So can you grow 30% year over year? Can you do some sort of quantifiable number that's actually based on past year's projections? What I do is look at past year and kind of average out and just see what the percentage growth was and say, can I hit that again this year or make it, quantifiable? With that, how much do you want to save? That's on the personal finance side. Like, how much do you want to save? We'll talk more about that. This is the thing that my fiance added in that I think could be helpful, creating a contract with yourself. So write down the goals and objectives that you'd like to make for this year and literally sign it. Because a lot of times I was explaining from my past when I would just make a goal sheet and write down bullet points of what I want to do, I would just like forget it and not even look at it again to the end of the year. But now if you make that contract with yourself, it's more on top of your mind, right? Every month, maybe you're looking at it, that you signed the deal, contract with yourself, that you're going to work on these objectives every day, every month, every week in 2024. And you owe it to yourself to actually do that. So it's kind of like making a deal with yourself, helps keep yourself accountable. Maybe you do it as a family, it helps you accountable and your family accountable. Maybe you do it in terms of your business and your employees. You make them all make contracts for themselves because it's super, super important. I think it actually helps you stay much more accountable. And then what a big expenses, this is just another area to think about on the finance side. What expenses do we have for the year? Can we model that out so we're prepared? And we'll talk a little bit more about that. I do think if you haven't already, you can assess 2023. What were the goals that you had in 2033 and how did you do? Were you saving for a house? Were you saving for your, something, a big investment for your business? Were you going to hire employees? Were you going to expand in a different market? Were you going to get another rental property? Did you do these things that you wanted to? If not, why did you not do them? And how can we change that in 2024? Some of the big things is growing businesses, maybe start a new project. Those are all things we can assess. Reviewing income, expenses, and cash flow, like looking back and seeing how did you do when it comes to an income, cash flow perspective, right? Like that is a huge thing to look at because if it's a variation in a huge way from 2022 and 2021, then we can dig into why. Why was it such a big variation from the prior couple of years in 2023 versus 2021 and 2022? And how well did you allocate resources? As a business owner, you know that your capital, your money, your funds, your savings, those are important. Why? Because you have to allocate those resources to bring you a return on investment. So how well are you doing that? Look at the way you look at where you allocated your money in 2023. Was that the best use of your money? We can't talk specifically about investing, but we'll talk about, all right, now do you have cash sitting in some sort of investor business checking or savings account that's giving you 0.25% or 0.1%? Could you have had that in a high yield savings? Were you just keeping cash in a checking or savings that you pulled out from 2022 that you could have actually had invested in the market because the market had an incredible rebound in 2023? Now we can't project 2024, but we have to look back at the past and see what we could have done better as far as allocating our resources in the past year. So that's a crucial point. And it's part of the review of 2023 if we haven't done so already. Now let's do a case study on like actual goal deep dive and actually how we could implement it, right? Let's say your goal in 2024 is improving cash flow. So maybe a couple of things that you could do as a business owner is, and someone that's, trying to improve cash flow is looking at how you can optimize receivables. How are you doing on your net payables? How are you doing on your ability to get paid back? Are you invoicing in time? Are you collecting invoice? Are you staying on top of these net 30, net 60, net 90-day invoices? How is cash flow being optimized? Could you do better in that area? And if you could, what are we going to do that? Can we shorten the time that we receive money? Can we invoice better? Can we shorten our net payables? All those things are better. If you're a real estate property, are you getting your rent on time from your renters? Are you doing any of those things? If you're in retail, how are we doing that as far as optimizing receivables there? It should be right away, point of a system cash right away. So all these things are important. Now, negotiating payment terms, again, this is more for invoicing. If you're dealing in a business that has to negotiate payment terms and has net 30, net 60, net 90-day payables, negotiating, giving a discount for earlier payment could be something you implement if you want to improve cash flow. And we talked about this earlier in the slide. When you project your big expenses for the year, whether it's on the business side, whether investment in employee, expanding to a new market, or on the personal finance side, whether it's a vacation, house, wedding, how are we getting prepared for that? One, have emergency cash flows for anything, or emergency cash reserves for anything that could pop up in the future, right? So that's a big thing that people are really want to utilize in 2024 because it's a new landscape than it was in 2021, right? 2022 was a bear market, but the market itself, demand was still there. 2023, 2024, we've seen the economy slow down. So we want to have emergency cash reserves and forecast your cash flow. If you're forecasting, you'll have a much, much better time dealing with things that do pop up because you could potentially be prepared for it, right? So that's one thing to think about as well. Let's do another case study. If the goal for 2024 is debt management, so we want to, one, assess our current debts, whether it's the credit card, whether it's any student loan lingering debts, anything that we have outstanding. We have to make sure we have a good accounting of where they're at, how much they are, what the repayment is per month minimally, what the interest rate is on these debts. So understanding that is super important. Then we can prioritize repayment. A lot of people like the highest interest one first. So if you want to attack the debts with the highest interest, especially when we're dealing with credit cards, that should go first over any other thing, right? That should be how we prioritize it. And then maybe other people like, all right, it's just small debts here on credit cards. Maybe you're just doing the smallest payment first, the snowball method, right? So those two methods, high interest or the snowball, pay off the lowest balance, get some momentum, start paying off the next, put more than the minimum balance on it. That will help us get that debt payment down. Consolidation options, always an option for people that want to look into it, right? Like consolidating means taking all your different debts from different places and consolidating it under one roof. There's a lot of companies personal finance and lending companies that do that out there. The advantages, it'll be more centralized. They could potentially give you a better rate, potentially, depending on your credit profile. And that goes with the last thing, negotiate with creditors. Have a credit report. If you're looking at your business credit or your personal finance credit, or if they're one and the same, if you're looking at your credit report and you're seeing lingering items, get those taken care of. You don't need to hire, you can, but you can go to a credit repair company, or you can look at a report yourself and figure out what's the debt that I owe, how do I get this paid off, can I get this taken off my report? Those are definitely things you can even do yourself in 2024. If one of your deep dive goals is debt management, super, super good for us to look into. So we did set the table before we get into budgeting, saving for retirement. I wanted to stop and pause for a second, see if we have questions in the Q&A in the chat or the Google form. The Google form might be already in the chat, but let me see if Jenny and I have anything so far. We appreciate all the questions that we are receiving, if any, at the current moment.
So I don't have any in Q&A or chat at the moment.
Perfect. And this was a set the table. Let me make sure we have and double checking our slide deck. So if everyone wants to take a look, you can, our Google form. I just put that in the chat. If you have extra specific questions, make sure you can use that Google form so we can keep context. Let's dive back into budgeting and saving for retirement here. Another option for us, for all of us that are looking as business owners, sole proprietors, any which way we're thinking about this, budgeting and saving for retirement is something that we're probably on top of our mind in 2024. So if you think about the budgets and the simplification of it, think about these 4 buckets primarily as ways to think about how you are saving and how you're budgeting for yourself in this new year. Essentials bucket, our emergency bucket, and our investables, as well as our spending. So as you can see here, the essentials are mortgage, car loan, things that we have to do pretty primarily, right? In the emergency fund, we keep coming back to it. This is another avenue for us to have emergency cash reserves. Once you have above and beyond a certain amount, you don't need to keep stuffing money into an emergency fund unless that's something that you just like to do, because you could go into investing. And as obviously as all sole proprietors, as owners, as business owners, we have different avenues to do that. We may not be a part of a 401k plan. We may be if we're W-2, but if not, we might have like a SEP IRA, which we'll talk about, a Roth, a traditional health savings account, a brokerage. All those different things are part of investing for us. And of course, we have our spending and discretionary, which is something that everyone should have. So again, another way to look at the budgets and the bucketing is 40 to 50% needs. Saving and debt requirement can be anywhere between 20 and 30, and wants, can be anywhere between 20 and 30. That difference, or the range, can be what you want to do on saving and debt versus wants. I think the saving could be a little bit higher. The wants could be a little bit lower, especially when we're starting out. That's a way to look at it. So that's important for us to understand if we're thinking about our business and how we're trying to, one, pay ourselves, right? If you're a business owner and you're paying yourself, you can bucket all your salary just this way. If you're a sole proprietor and you're paying yourself, you could also bucket your business and revenue and your income this way as well. So a great way to look at it in the after tax, how it kind of breaks out, and we'll let you see the numbers there. Saving and debt repayment at the 2,000 amount, wants 3,000, necessities 5,000. So again, the biggest necessity for most people is going to be mortgage or rent. It's going to eat up the most amount of someone's budget, honestly. So after that, how do we want to get fancy? How do we want to allocate our resources that we talked about earlier so it's best optimized for ourselves? And of course, we'll talk about how investing can work for us, or how retirement can work for us, and just investing in other areas of maybe your business to grow your business. That's also key as well. So as we think about it, we have personal and business expenses. Now, for people in this, there's different industries here. There's real estate, there's professional services, there's all these different areas. So if you have your business expenses and you actually have it's split from your business and personal, here's a way to think about it. On the personal side, it's just your income. Maybe you're paying yourself and you have fixed expenses, your mortgage, your rent, all these different things. And on the personal side, you have, after that, it's gross profit. Then it's maybe variable expenses. That could be some other things that come into play. And then, after that, it's savings. So the variable expenses could be your wants, right? Because you can change that from month to month based on what you do. And then your savings would come at the end. On the business side, it's very similar. You'll have your revenue from the business, cost of goods sold, cost of doing your business. If you minus that out, you have, of course, your gross margin. Then you have general expenses. So that could be anything in a general administrative expenses for you. And then at that point, you get your net income. So maybe this is one and the same for you as a sole proprietor. For myself, it is. A lot, honestly, for other people that have different business models, different setups, it may not be one and the same, but you can look at it, in a way that's synonymous with each other if you look at it just kind of like this. So the other way to look at that on the business side, breaking down the actual terms, as we talked about it, revenue and sales, we know what that is. Cost of goods sales, direct costs attributable to production of goods sold. We have any manufacturing people in here, any of those things, those are, of course, what those are. Gross margins, and then we get to minus off the general expenses, we get to our net income. So simple profit and loss statement, nothing crazy, but it's just another refresher for people. And if you're trying to do this on, yourself on a spreadsheet, always good. If you have a spreadsheet that does this for you, for some of my stuff, I have a spreadsheet. For some stuff, I use apps. Some stuff I use both. But here's some different apps in different areas. You can use QuickBooks. You can use Personal Capital on the personal side. You can use QuickBooks on the business side. You can use all these different tools to automate, to make it more efficient, to make life easier for you as you're looking to kind of go through this process. Because again, if you have a spreadsheet that works, that is totally fine. But there are systems and software that could potentially make this a lot easier for you. Now we'll shift a little bit of gears from budgeting to retirement. And that's something that as business owners, maybe you think about, maybe you don't, because you're just building the business. But what does that actually really mean to you? I think it means financial independence for a lot of people, the ability to step away maybe from your business and either not have to have income or have income, but it's not directly tied to your input. So that means you'd have enough saved that you can cover life expenses. You have enough saved that you can really feel like you could comfortably go through the rest of life with not having to have income. But maybe you do have income from your savings that are invested. Maybe they're spinning out dividends or interest. So we'll talk about that in compound interest and how that could work. But we do have to plan for it. Maybe we're using an investment calculator, or we're thinking about selling our business, we're doing different things, or still about selling a property. But how do we actually effectively plan for it? It's something that we're all working on, right? And when it comes to like the base way of retirement accounts and different things, there are different ways for people to invest and different brokerage houses. But let's talk about this way to look at it. So you can have brokerage retirement. It could be with Schwab, Ameritrade, Fidelity, Vanguard, all these different things. Retirement accounts the same. It can be under Schwab, Ameritrade. Robinhood just does, at this current point, as far as I know, they just do brokerage. But I'm showing you this to see that there's so many different ways as far as setting up account types that we're going to talk about in the coming slides. So many different avenues and ways to do that. So it's not one is better than the other. It's just which that you feel best for you, or maybe you're working with an advisor, which one the advisor works on. Those are super important to understand. But again, it's very, very open. And again, if you're doing a lot of your retirement through, accounts and different things, here's some terminology that you may be familiar with already. Of course, you know what stocks are. Owning a portion of a public corporation. Bonds probably came more on the front of mind in last year because of interest rates being raised, and the treasury, the very, very treasury yield going up, which is of course one of the safest. It's probably the safest bond and investment you can make is treasury bonds, which are tied to U.S. government or backed by the U.S. government. So, and again, a bond, you make a loan, you're getting paid those interest before you get the original principal loan back over a certain period of time. So you have to understand those things. But mutual funds, as you know, is a collection of stocks and bonds and other securities, and index funds and exchange trade funds. Index exchange trade funds have become a lot more popular over the last 5 years to a decade because they're liquid like a stock, but they kind of have the components of a mutual fund, meaning it has different shares or different indexes within it. So that's something to understand. And then inflation, we've talked about this. We've probably seen in the news. It's a big part of what's going on economically, and we could talk about that a little bit later as well. So if you've never seen an investment calculator, I just threw one up to show what happens with someone that starts with $5,000. They invest for 30 years at a 7% average annual return rate, right? So if you take a back look at the market for the past several times, like usually people use a conservative barometer of 6 to 7%. To look at a long run of compound run of what they would get in the market, right? So that's a healthy return. That person was contributing $1,000 a month. At the end of those 30 years, based on the calculations, the contributions, the interest, the gain, they would have 1.2 million. So the point is to show like it's a long-term game. Understanding where your number is for your cost of living is also part of that game. It doesn't have to be 1.2. It could be whatever it is for 800,000, 500,000. It doesn't matter, but it matters on your cost of living and what you plan to do in retirement, if you'll still have income or not, or you're selling a business. Those things will all factor in, but it's good to show a little bit of what happens when you invest early. I talked about the different brokerage houses earlier, but now we're talking about the different retirement accounts you could have, right? So remember, there's 401ks, all these things that people have their W-2. If you're sole proprietor, if you own a business, you can have retirement accounts, should have retirement accounts, not only for you, your employees can also have like different retirement accounts. So if you look at it, some of the tax advantage ways that the government, the IRS set up and legislators set up for people to have retirement contributions and have retirement accounts. Traditional IRA, if you're a sole proprietor, your contributions are tax deductible. So the limit now for 2024 is 7,000. Same limit as the Roth IRA, which is the after-tax retirement investment account, that distributions in retirement aren't taxed, as opposed to your traditional IRA, your pre-tax 401k. When you take that money out, you will be taxed at your income tax bracket at that time. And of course, we know that these are retirement accounts. So the IRS set up the stipulation that you should wait, if you can, to your 59 and a half to withdraw from them is to evade a penalty. There are some alleviations on that depending on situations. Same with the individual account, different from the two. It's a brokerage investment account, has no contribution limit, has no stipulations on when you can withdraw. But these are vehicles as far as like when you put money in, the money can be invested, and you can at that point use these as a vehicle potentially for retirement. So we talked about traditional, we talked about Roth, we mentioned SEP IRA, we haven't mentioned solo. The SEP and solo are different ways for self-employed people, for business owners as well, to save for retirement in a tax advantage way. So SEP gives small owners benefit because it has a higher contribution limit. As we mentioned, the traditional and the Roth are 7,000 for 2024. We'll go over the SEP and the solo, but they have a much higher contribution limit, and they are tax deductible in the sense that when you contribute to them, you can lower your taxable liability as a business owner. So those are super, super important things to note. Now, if you've worked in a business before or worked a W-2, maybe you still do, people forget about rollovers, which allow you to roll over old 401ks from old plans that you've separated from into IRAs to have it organized, properly managed, to resume your contributions. So those are things that you should and can do, especially if you have old plans from 5, 10 years ago, you even forgot about it, can't access it, can't log in. Those are super things that need to be done when possible for you, for your own benefit. This is another graphic showing that when you start early, it could be beneficial. So again, someone starts in the green line, 5,000 per year at 25, in the gray line, 5,000 per year at 35. And you can see that the 25 person hits over 1.25 million just because of that extra 10 years compounding, which plays a lot role, right? And this one assumed an 8% rate of return compounded annually. So another illustration on how we can do it whenever we can. We could start doing this, especially as business owners and sole proprietors want to think about that for ourselves. Break, pause time, anything. We'll see if there's anything in the chat. We will take a
Yes.
little break at this point.
So, Delano, if someone is just starting out with as a business owner and wanting to set up retirement items for themselves, what would be your priority list as far as what to do first and think about next?
Yes, so it's a great question. So one, I would have some sort of retirement account open, right? Whether it's a Roth IRA or traditional IRA if you're a business owner or sole proprietor, because that will allow you to just have it ready, set foundationally. Maybe you're not contributing to it right away. There's no penalty for having these accounts open. You don't get penalized if you don't contribute right away, right? Because I know the main focus for a business owner that's starting a new business is going to be generating revenue, getting clients, selling your product, selling your service. So have that open. And then once you get the traction going with your product, your service, you're generating revenue, you have net income, then you can start contributing, and you can set up automatic contributions when you have a decent traction of what you're making or what you project or what you are making per year, per month, per whatever variance that you want to put on it. But once you have that and you already have it set up, now you get in the habit of already contributing. Because I see a lot of people that they'll do well, they start to making money in different things, and they'll just keep it in a business bank account or keep it in this checking or savings. They're not earning anything on it, when they could at least be earning something on a portion of that money. And so that will be really, really crucial for them to do so. So that's what I would suggest. But of course, the main objective is start, have that account open, but focus on your business, focus on generating, focus on working with SBDC, all the research you have, so you can generate income, generate revenue, generate profit, and then you can start contributing. But if you have it set up, you'll be in a good place.
Thank you. So a related question, what would you recommend further in terms of creating a sliding scale budget for a new business who, so this is a sole proprietor, no employees and no overhead cost, wants to plan for retirement and investing, but the immediate goal is debt payoff?
Yeah. So sliding scale budget for new business. So I think the scale is like, all right, how much do I pay off versus how much do I invest and save for retirement? I think it's a good, interesting way to look at it. I think credit card debt, those should be attacked first, right? So if the debt is credit card, it has a high interest rate, right? Like it has a much highest interest rate. So even if, it's say 19, 20%, if you were getting the average rate in the market, it would be, 7, 8%. So you want to don't want to give up that great percentage. So you want to maybe, when you don't want to, maybe you want to for sure pay off that as much as possible. So all your extra revenue, all your extra income will be to place on the debt. Then once you get to come to a place you have it handled, and maybe you're just using your credit cards to go through expenses, but you're paying it off right away, then you'd for sure want to look at placing a little bit more into retirement, and putting that money based on your revenue and your income into retirement every month, every quarter, every year. But you definitely want to pay off high interest debt. If it's not high interest debt, if it's like something much lower, whether it's student loan and you had for 15, 20 years ago or something, when you got a much lower rate, 3.2 or 2 point something percent, you can do 50-50, you can do a good percentage. You still want to pay your debt off as quickly as possible, but it's a different situation where it's not high interest. So you're not really getting as crushed as much, right? So I'm not a person that you can't invest or save for retirement unless you have all debts paid off. I think the high interest for sure. But then once you get past the high interest, it's kind of like really a preference thing at that point.
Excellent. Thank you. So at what income or profit range would you go with a Roth IRA versus some of these other options, like a traditional IRA? Deferring tax can be good, but it lowers loan amount if you want to get capital from lenders, is this person's comment. So thoughts on that?
Good question. So it depends again on one, your income. Like, so for the Roth IRA, for example, if you are actually paying yourself a certain amount, or if you're a sole proprietor, there's actually an income limit for people that can actually contribute to Roth IRA. So for 2024, it's like 146,000. You could look at it online to find the exact amount. But if you're making above and beyond as a single filer, there's a number for the joint filer. It's above 200,000. It's like 230 or 40,000. You can't actually even contribute to the Roth IRA. You have to do something called the backdoor Roth conversion, which is contributing to a pre-tax account and then converting that to a Roth, so the IRS can actually take their amount before it gets into the Roth. So that's one thing to consider, is there's actually a contribution income limit for the Roth IRA. As far as like what makes sense for you, if you're bypassing that, what makes sense for you besides traditional and Roth, that's a good point. If you're looking for ways to show higher income and so for business lending, if you're a sole proprietor, then yeah, you probably want to. Well, but if you speak to a tax professional, but the way they kind of look at it is kind of different, because you wouldn't really be lowering your taxable income. It's like looked at as a different way. It comes off the bottom versus like lowering your taxable income as far as contributing to the traditional IRA. So we're getting to the nuances, but you want to really speak to a tax professional or your advisor to understand what would make sense for you, but you're not like lowering your income per se by contributing to a traditional IRA. You're not lowering it on paper on tax. So it gets into a very nuanced thing there, but you'd want to just, one, think about it if you're above the contribution limit for the Roth, and if not, which one makes sense for you in the current situation. But it is a preference thing, and one you have to kind of consider all these nuances.
Thank you. So we have someone who would really like more detail on the SEP IRA and solo 401k.
Nice. So we are going to get into more of the SEP and solo. So the person with that question, I'm going to touch on it a little bit. If I haven't fully touched on everything, please write me like, hey, I still want to understand it. One, shoot back in the chat, because I think there's a little bit more we could touch on, because those are important for us sole proprietors, self-employed folks like us. So we'll talk more about it.
Okay, and related to that question, we have one about, can you convert an individual IRA to a SEP IRA?
It's a good question. I want to look into that. So I haven't seen that done, but I actually think you can. So let me verify that, but and get back to you. But that's a great question. I haven't done that for anyone yet, but you actually, I believe, can do it. And there's some nuances with that. But I wanna. So if that person, one, hit up the Google form if you haven't, so that we can get connected. But there are some nuances in that one. But yes, that's actually a really good question. I'm 78% sure that you can, but I want to double check that for you.
Excellent.
78 is very specific.
So I was like, wow, that's really
70
specific,
to 80,
Delano.
78.
So you mentioned some recommendations on apps and different types of
Yeah.
software. for helping people to track things. We have someone who is a new business with no employees, and they're looking for something hopefully
Store
free
receipts.
to store receipts.
Interesting. So receipts. So I use for a service business, I use a so new business, I'm assuming it's a service business, then it could not be, but I use an invoicing platform called Wave, and you can actually, when you send an invoice, it gets paid, you can have a receipt, like you'll have all your receipts. I'll say, hey, do you want to send this person a receipt? So you can have all that stuff. Whatever invoicing platform you're using, or whatever selling or whatever platform you're using for your actual payment, it should give you the option to do that, to keep the receipts and store it. Wave is the one I use. It's actually free. You mentioned free. Wave, the base function is free. I haven't paid for anything on it, to be honest. And there's probably stuff you could add on, like they do tax and different things, but the base function is free. I'm assuming the same with QuickBooks or any of those others. The base function will be free, which for Wave, it'll give you the option for receipts there. So Wave, it's called like Wave Invoice. That's a great option for you. And I can post a link later, but if you Google search just Wave Invoice, it'll pop up. So that's a free one, allows you to keep receipts. There's probably a bunch of others that have base functions that are free as well.
Thank you. Another conversion question. So can you convert a 401k into an IRA?
Yeah, 100%. Great conversion question there. Convert 401k into an IRA, you 100% can. So your old 401ks, that's very like it's pretty crucial for a lot. Like I do those a lot for people because one, you want to convert it from, if you left the job, you can convert it into an IRA. If you separate it from the employer, convert it to an IRA because it allows, if your advisors management, better management on that side. And then it also organization. If you have a place where all your, IRAs and stuff things are, you don't want to keep all these old 401ks of jobs you left that you had for 4, 5, 6 years. You're not kind of floating in the ether when you can convert. It's called a rollover, roll it over into an IRA. So that's 100% something that we see a lot of people do. And I don't know who the question was, but make sure to fill out the Google form if you have more questions on that.
All right, that takes care of all of our questions at the moment. So go ahead with your
Perfect.
presentation. Thank you
Love
for
it. Love it.
addressing those.
Great, yeah, great questions by everyone. I think that was a really it was a meaty subject in the sense of like and there's so much more there. So again, Google Form, if you had those questions, even the people that asked, Google Form again, because I can maybe impart more information via email, because it is a bigger subject as far as like what we can all do and what should and can be done. All right, so tax strategy. So the tax strategy is more of like, it's more tips and overall things, not exactly like do this, right? Because like you want to make sure you talk to your CPA about doing this or that. But it's high level because we talked about these retirement accounts and potential benefits. We talked a little bit about traditional being potentially tax deductible for you in the year you make those contributions. Again, there was a good question on that. It doesn't really lower your taxable income. It just kind of like takes it off the bottom on what you would potentially owe, your tax liability. But again, speaking to CPA, but it wouldn't be lowering taxable income, which is a good question in that regard. So let's talk a little bit more in depth about those. So we talked about 401ks. Again, if you're old, from an old employer, you haven't really been managing it, you're going to leave it there for decades without management, you'd want to do a rollover, and you could do that into something like a traditional IRA. It's individual retirement account, not sponsored by employer. If you're, and these are old numbers, so the limit's now 7,000 for 2024. And if you are over 50, they give you a little bit more on the contributions to IRAs, as well as a SEP, a traditional Roth. So we could talk about those. But if you're over 50, you have the catch-up provision, which allows you to contribute more to those numbers. So again, the Roth IRA does have income limits, and the 401k can be rolled over into traditional IRA, as we mentioned, right? So in the traditional IRA, when you make contributions, if you're solo proprietor, solo employed, not privy to a 401k plan, no one in your household is, you are potentially getting tax deductions for the contributions you make. And of course, you'll pay income tax on it later on. Roth IRA contributions are post-tax. You've already paid income or taxes on these dollars that are going into the Roth. So now the government deems it as after tax. So when you take the money out, you won't pay taxes. So another breakdown of that, Roth IRA, you do pay tax up front, or they're already taxed after tax dollars that are going into the account. It's not like you have to like go to the IRS and pay. It's like it's already after tax money that you put into it, and you don't pay taxes on the distributions and capital gains. 401k, you can do, it's pre-tax. So the money that you go into a 401k or traditional IRA is pre-tax. You will pay taxes on the back end when you take the money out later. So when you pay income taxes, when you withdraw the money on the pre-tax 401k and the traditional IRA. And then talk a little about brokerage accounts. What happens in those? Remember, those have no contribution limits. You're able to save and put money in there. If you put money into, let's say you buy a stock of Apple for $100, and you held it for less than a year and it went up to 110, you will then pay short-term capital gains if you sold it under less than a year. So if you held it for less than a year, sold it after 9 months, you'll pay regular income tax at that time. Now, long-term capital gains is in the brokerage account is if you buy a stock, you said Apple again for $100, it goes up to 110. You sell it after a year and a half after you sell it. Now you'd be in the capital gains bracket. And so it tops out at like 20% based on income, but you more than likely would have even less than that, right? But at that point, you're in capital gains. That's the same thing with a lot of things. Your business, again, if it's an asset and you sell it over a year, you're paying capital gains, not short-term. You're paying long-term capital gains, not short-term. So that's the same thing with a business. Your business, if you think about that and you're like transitioning from that later on, you will also have the same thing there. So SEP IRA, we talked about that. It's a self-employed IRA for self-employed folks. I typically see a lot of sole proprietors have this. Again, the contribution limit is higher. The contribution is tax deferred, or earnings go tax deferred to lower taxable liability. And so the SEP IRA contribution limit for 2024 is that the lesser of up to 25% of compensation or 69,000. So whatever the lesser is, solo 401k, solo Roth. Again, I usually see this with people that are self-employed. Again, higher contribution limit for 2024, 69,000, or with the catch-up provision. If you're over 50 and a half, you can go up the way up to 76,500. Same thing for the pre-tax money. It'll be tax deferred, but if you do it solo Roth, then it'll be after-tax money that's going in there. Simple IRA. I usually see this with clients that have employees, less than 100 employees, maybe they have 5 or 10 employees. And it's kind of like that 401k, but it's for a smaller organization. That contribution limit, so what we usually see is they contribute to this, right? They meaning the employees, they can defer a bit of their salary into this, and the employer will match that percentage. And the contribution limits for this is 16,500 or 19,500 for those age 50 and older. So simple IRA is like kind of that 401k for small organizations. You get the ability for your employer to match while you, as the employee, can defer a bit of your salary into the simple IRA. So there is some benefits for both sides, for the employee, the employer, but these are the breakdowns and the abilities of these SEP IRAs. Again, all these accounts were just mentioned are just account types. Once you put the money in there, it doesn't just sit, it shouldn't just be sitting there, it doesn't do anything. You actually have to have it invested and grown either by yourself or an expert, right? And so these are just account types that have different tax stipulations or contribution limits. They don't have one's not better than the other based on any of these principles. It's all preference. And then from there, it's how it's being properly managed and grown. So that's something people forget is it's just, okay, I just put the money in there, but like what happens after that is important. So this is kind of like a two-parter last thing. So I do see some questions. So I'm going to stop there and then we'll do the last slide and then talk about New Street at that point. But I do want to stop because I do see some questions, I believe, unless the chat's just chatting.
No, we do. We do. So for a Roth account, we have someone who contributes from a personal checking account, and it is already after tax when made that way. So is this person getting double taxed essentially by doing it this way?
So it's from a personal checking account. No, it's not being double taxed. When it goes to the Roth, it's not going to be taxed again, right? So it's only when they say after tax, it just means that the account itself is deemed as anything that comes in here has already been taxed. So you're not going to get taxed again on it, right? So when you pull the money out, provided you're above the age of 59 and a half, there's no IRS 10% penalty. There should be no tax. So I think that answers that question. But again, let me know if we're missing a nuance there, but that should answer that. And I'll answer the tax questions best of my abilities. You definitely want to speak to a CPA for like really in-depth questions because I'm not a CPA. We do high-level stuff and we help people get the correct account types for them. But we'll answer as best as we can. As far as if I don't know, I'll definitely tell you.
So what tax rate does the back-end tax, what rate is that at? So, because this person is saying it sounds like the Roth is better now while income is lower, as you know, in comparison to later. So
yeah, that's usually the kind of the thinking for people is that if income is lower, they want to put money into a Roth because if they anticipate their income being higher later on, then if they let's say they had a traditional IRA, of course it's income tax bracket. I don't know what that will be for you in 30 years. That's based on whatever happens in 30 years. So let's say 30 years your income is a lot higher and you're taking money from a 401k or traditional IRA, you'll pay income tax based on whatever withdrawals you make during that year and what your income tax bracket is that year. Now, let's say you're retired and you're only making money from like dividends or interest, then it's a little different situation as well, right? But again, it's a crystal ball. No one can tell you what that's going to be for yourself in the future. But yeah, the general rule of thumb is if you anticipate income to, go increase and you're going to be making withdrawals at a certain time, then you'd want to potentially stuff a Roth now if possible, because then when you're making withdrawals, your income is lower at that time, maybe you're retired or different things of that nature. But again, no one will know. It's a crystal ball, but there's no way you can know the exact tax bracket unless you already know, which would be interesting. But yeah, that's a good question.
got it. Okay, we have a couple of questions about type of business, like an LLC, sole proprietor, etc., and the types of accounts that are available. So if your business is an LLC, can you have a SEP IRA or solo 401k?
If your business is LLC, yeah, 100%. So if your business is LLC, you can have a SEP IRA or solo. You have to for the SEP IRA, the main component is have some self-employed income. There's people that are not even registered as LLC or anything of that nature, and they still have a SEP or solo. So you can certainly have that if you have an LLC.
Okay, so when you have an LLC, can you contribute from your business to your IRA or another type of retirement account?
Good question. So the IRAs are individual retirement accounts. So you have to have, again, to the best of my knowledge, it has to really be an individual account. So you can, pay yourself and then fund the account type, or you can potentially fund it from a business account. But again, it's still going to be under you as a person, right? It'll be under your name. As far as the Roth or traditional, it'll be under you, the person. So you could hypothetically fund it from something else, but again, the account type itself is going to be under the individual, not like a business IRA or any of those sort of things. It's a good question.
Okay, I think we've got questions for now. So if you want to go ahead and finish your presentation, and then we can take any more questions after that.
Perfect. Let's keep going. Where were we at? We are really at a couple more areas that we wanted to touch on. One being, let's see, there we go. One being, so we touched on the SEP IRA, the solo, simple 401k, all those things are super, super important. Lastly, I brought this new slide because I think it's important, or it's interesting enough for me, like as business owners, sole proprietors, if you had the ability, how we think about selling a business and retiring or transitioning from said business. So again, it's really about looking at, what's your reason for selling? Maybe you're passing on to a kid and they're buying into your child and they're buying into ownership. Maybe you're passing on to a long-standing employee and they're buying into ownership. Maybe you're using a broker to find a buyer, or maybe you're finding a buyer yourself. So, but what are you doing it for? Of course, retire, transition. Maybe you want to get into another industry. Thinking about those things is always important. And so with that, like, what is the value of something that you're selling, right? It gets tricky, and it's obviously based on who's the buyer, but there's some valuation techniques that people use. They look at cash flow, meaning in a lot of cases, if it's a streamlined business, your net profit. You apply a multiple. So it could be 3x, 4x, 5x multiple. The multiple goes up based on, if someone, whether that's you, buyer, believe that the business has more value based on different things. So the multiple itself is actually taking your business cash flow and looking at comparable businesses and, comparable exits, meaning someone else had sold their business and what did they sell it for. That multiple usually can range from anywhere. It can range from a lot of things, but let's say in a normal business from between 3 and 7 times, right? So cash flow being 3 and 7 times, um, multiple being 3 and 7 times cash flow. So I'm just gonna do a $300,000 business times 7x, 2.1 million. So if business is cash flow, and again, this is just hypotheticals. Someone cash flowing 300,000, if they actually found a buyer that would pay 7 times that, then they would be able to exit for 2.1 million. But again, that's once you get into $400,000-$500,000 range of cash flow, your business becomes much more viable for selling. And there's markets to define buyers and sellers. There's websites, there's different marketplaces, there's brokers that help do this. But something for us to all think about, right? If we're thinking about selling a business for myself, starting a new thing and looking at potential exit multiples in 5, 6, 7, 8 years, right? Those are something we should all think about, especially when we're looking to transition. Because what happens when you leave, transition, retire? What happens to the business is super, super important to think about. Lastly, myself, New Street Advisors Group, and my firm, of course, we do business advice, coaching, financial planning, investment management for a lot of people. So that's the main thing of it. I didn't want to go too much in this. So fill out the Google form for those folks that have questions, want to learn more of those rollover questions, different things of that nature. We'll be able to answer that for you and help you get on the right path for what you're looking to do. So anyways, if people want to reach me, this is a nice place you can screenshot emails there, Instagram, LinkedIn, Facebook, Twitter, the website, podcasts as well that we do every week. So feel free to screenshot this and just get and reach out and connect if needed. And we'll be able to share some ideas. That is all I have for that. We'll see what questions we have, Jenny. See a couple maybe, but might be
I'm
good.
putting a few announcements in the chat. So
Perfect.
we have in the chat, so Delano has put his link there. I'm also putting some links for upcoming trainings that we have. And also, if you are interested in the NYSBDC's free advising services, we are a government-funded program, and so we are able to offer some amazing benefits at no cost to business owners. And so we have some information on links to get in touch with your local center there. Again, there are 20 plus a whole bunch more outreach offices around New York State. So there's one somewhere near to you, no matter where you are in the state. And let's see, we're not able to take questions verbally today. So Tanya, if you have a question, please drop it in the chat or the Q&A box. And we'll give her a minute, or anybody else who has more questions. Go ahead and put those in the Q&A box or chat right now. And I just want to remind everyone that you will receive a follow-up email with a link to the recording and also a PDF copy of the slides. I know Delano shared a lot of fantastic information today, so those slides can be really helpful to review and find those things that maybe you want to go back and take a closer look at from the presentation. Also, when I shut down the webinar in a few minutes, we do have a follow-up survey that displays right then. And if you have a few moments, we would love to have your input on our webinar today. We always appreciate getting feedback from our viewers. Okay, so we do have a question. Is there a resource for the best pre-tax retirement options for a business to directly contribute to retirement?
So same thing here. The resource itself, there's no resource, right? There's just different brokerages, and then if you're looking if you're trying to contribute as a business owner, LLC or any of those things, you could have your own as a person. You'll have your own retirement account, right? So if you're like, you have an LLC and you're paying yourself, then you can also just fund your retirement account, whether it's a SEP or any of those different things. So there's no different like nuance there in the sense of that the business itself is like, besides a simple IRA, that's where an employer can, contribute to the employee. But all these will be individual retirement accounts. So it'll always say just your name, right, as the person, the individual. It won't be like a business account, right? So there's nothing better than the other. You just have to pick the best retirement account that fits your situation. And then from there, you can fund. The money can come from wherever. It can come from your business, it can come from your personal, it can come from, someone else that will use money. And as long as it's for a service, like it can come from anywhere, but it's the point of you have to have as an individual the right account for you, and then the source of funding can kind of be like, wherever it's going. But yeah, hopefully that makes sense. It's not a advantage to like have it come directly from your account, or it doesn't mean anything per se. It just is what's the best retirement account for you.
Okay, I think that wraps it up for our questions today.
Perfect.
So we will wish everyone a lovely day, and we will thank Delano. You've been
Thank you, Jenny.
amazing as always. We enjoy having you and the knowledge that you share with everyone so freely. It's very, very appreciated.
Appreciate Jenny.
Okay. So remember, you can reply to that follow-up email that you'll get with the recording and the PDF if you do need further assistance. And wish you all a lovely day. Goodbye.
Thank you guys. Thank you all. Thank you, Jenny.